Coming to global economy, the inflation is dropping across the world, which is why now various governments are talking about their own Ladli Behna, Ladla Bhai schemes, and money will be printed across the world in 2026. The debt to GDP ratio for G7 economies is rising. That's partly because of stimulus and partly because GDP is not growing as fast as it requires more and more debt to grow. Consequently, we have reached a level which was not taught in our school or college. We were always told that government securities are the risk-free securities. Now there are companies like Microsoft, L'Oreal, Siemens, Airbus, which are trading below government securities. People feel Microsoft is more dependable than United States of America, or Airbus is more dependent than the European Union. As fiscal stimulus is going up, number of interest rate cut across the central banks will start coming down in next year and year after that. Today, Fed is likely to announce rate cut, but hopefully or probably we will see fewer and fewer of the same in the days to come. Global growth will slow down a little bit from the 2025 level, and inflation will go up a little bit because of the base effect. For market, the biggest risk remains one, US-China conflict on the technology side. Second, artificial intelligence. Is it bubble or is it real? The return of inflation as central banks have cut rate and fiscal stimulus is happening. And finally, whether there is de-dollarization. All this will shape 2026 in the days to come. One interesting phenomena is Japanese bond from about 0% interest rates as late as mid 2021. Now 10-year Japanese bond is about 1.93%. Undoubtedly, this can shake yen carry trade. This can have implications on global markets. Fortunately, in India, we haven't seen too much of yen carry trade money coming in. Hopefully, we will remain immune. Coming to Chinese economy, clearly Chinese government is pushing fiscal stimulus. They are spending more and more money to grow their economy. They also have their Ladli Behna scheme like a democratic country. Their investment cycle has remained fairly strong. If we compare capex as a percentage of GDP in real terms, many countries before China, like Japan, Korea, did witness high level of investment, but that was for a brief period of time. China is running marathon at the speed of a sprint, which Japan and Korea did in the 90s and 80s. Can they continue to run at gravity defying speed? Well, so far they have been doing it. Who knows where is the future? By virtue of their large investment, they have excess capacity. They are manufacturer to the world with almost one-third share of global manufacturing at more than $4 trillion. And which is why they also run large trade deficit with most of the country. Because of this excess capacity, Chinese inflation is now below global inflation in developed nations, and their 10-year yield is now below Japanese 10-year yield. Over last 1 year, 2 year, Chinese stock market has delivered good return that has attracted foreign capital into China. From our point of view, while Chinese markets have done well, Chinese economy has done well, Chinese corporate earnings haven't done well. Over last almost 8 years, if we see, their earnings growth is barely about 20% compounded. The economic growth is not resulting into corporate profitability. In simple words, as companies have kept on investing, even at the risk of lower return. From our market point of view, we want to see whether China is 6-time lucky or not. In the past 5 cycles over 2 decades, Chinese markets have gone up and come down like Indian market had done between 1992 to 2003. We were going up and down, but not able to cross previous high. In China, that has happened 5 times. Will it happen 6 times? Or will they be lucky? If Chinese market corrects, capital will flow to India. If Chinese market continues to rise, to that extent, there will be less capital to India. What we could learn from China, the way they have become manufacturer to the world, their entire lending mechanism has moved from real estate to industrial sector, manufacturing sector. Can we push manufacturing or industry as a percentage of GDP from current level, or as a percentage of bank loans from current level, will determine how successful we will be as an economy. Earlier, I mentioned that Chinese economic growth is not translating into corporate earnings. And this chart also shows how marginal product of capital is slowly and steadily coming down in China. Because of those large investment, China today is global leader in many of the futuristic industry like solar panel, high-speed rail, electric vehicle, and so on and so forth. The other interesting thing is China at the forefront of research. This is related to medical science and drugs development. Just see how China's share has grown over last 25 years. India, unfortunately, is a very, very small percentage there. Other interesting thing to learn from China is the accountability of bureaucracy. If bureaucrats fail to deliver, they are punished as reflected in bottom hand chart. More than 200,000 bureaucrats have been punished for non-delivery. Wish something like that can happen in India. Chinese growth rate undoubtedly is impressive, especially related to futuristic industry. And they have employed all tools, Sam, Dam, Dand, Bhed, to be leader in futuristic industry. Coming to US economy, we have seen various cycles in US economy. There was a time when bankers and financiers were contributing significant part of S&P 500. Then construction infrastructure, railroads came. Then basic manufacturing like utilities, material, energy, real estate came. And now we are seeing IT, telecom, healthcare becoming large part of the economy and market cap. The drivers for American growth is Fed policy. They are likely to cut rates, government spending. Despite all the promises on Dodge, the fiscal deficit is widening. the tariff policy which President Trump has been utilizing successfully against its peers, and finally the deregulation where they are encouraging AI to create better growth. Last quarter, investments in AI and, and technology resulted into the overall growth. In the recent time, AI stocks have corrected, led by Oracle and other companies. Within S&P 500, despite price correction in AI-related stocks, the earnings growth is driven more by Magnificent Seven companies rather than broad 493 other companies. This divergence in earnings at some point of time will be reflected into stock prices as well. The real challenge for US is, after putting all these tariffs, will US be able to manufacture goods required by their economy, and will they have labor to do the manufacturing work, or they will need robots to do that work? One study shows that whenever US has levied tariff, over a period of time, it passes to the US consumer. In June 25, 25% of tariff was borne by US consumers. As of October 25, that proportion seems to have increased to 67%. And which is why now President Trump is talking about exempting certain essential goods. There are few signs of weakness emerging in US economy in terms of hiring and wage growth. Will this sustain and put pressure on economy, or will the Fed rate cut which are being announced take care of the growth? We'll have to see in 2026. The approval rating of President Trump has consistently kept on coming down. How does it prompt him to look at tariffs, or how does it prompt him to look at investment and other factors? US debt continues to expand. Din doguna, raat chauguna. Now it is touching $38 trillion. The current and fiscal deficit of US will be in double-digit combined, and fiscal deficit in recent times is comparable to either wartime period or crisis time period like subprime and COVID. From our point of view, most important thing, whenever dollar has depreciated, people have taken money out of America. As of today, almost $30 trillion worth of global investment is lying in America across treasury, equities, and corporate credit. With 10% drop in DXY index, they have already lost $3 trillion. At what level of losses people will shift from America to other markets? Coming to Indian economy, we continue to get headlines which are by and large supportive of growth. The second quarter GDP growth at 8.2% was much higher than expected. On the other hand, rupee went past 90 for the first time. Overall, from a fiscal prudence point of view, we are the only major economy to reduce its debt to GDP ratio between subprime crisis and COVID crisis. Markets have re-rated us in terms of how we are borrowing vis-a-vis US on a 10-year security. Our per capita GDP is now growing faster than Asian peers on a purchasing power parity basis. American tariffs are hurting some of the sectors like textiles, aquaculture, gem and jewelry, and handicraft. These are the sectors where large number of Indians are employed. And while our exports to US has come down, exports to other parts of the world has started inching up. The government has gone on overdrive to support growth, income tax rebate, GST cut, interest rate cut, eighth pay commission recommendation, which will probably get announced in 2027, effective 1st Jan 26, gaming ban, searching alternate export market, which we can't export to US, doing trade negotiation with US, and launching credit guarantee scheme, all are pointing that the adverse impact of US tariff on our economy will be limited. Slowly but steadily, our share on services exports have started rising, albeit on a goods export, we haven't done a good job. The GST cuts and festival season demand has resulted into higher retail sales across various categories. We have to hope and pray that it gets sustained in the days to come. The second quarter GDP growth was, as Swaminathan Ankleshwarya Iyer mentioned, like 1983 Indian cricket team winning World Cup. There were good bowlers, good batsmen, good fielders, and good wicket keeping and all-round performance. For the first time after many quarters, consumption, investment, and government spending all moved in tandem to create 8.2% growth. It was not driven by just one factor. The rebound was spread across agriculture, manufacturing, construction, public spending, trade, as well as financial services. This is all-round performance of economy, which gives confidence that probably this can be sustained. Rural wages have started improving, which is why rural economy is doing better than urban economy. Consumption growth seems to be maintaining the momentum thanks to all the steps taken by government for putting money in the pockets of consumers. And more importantly, this consumption is spent on Swadeshi good. Overall, we believe there are better chances of GDP coming above 7% for FY26 and between 6 to 6.5% for FY27 based on the momentum built. The government spending is plateauing out as government pursues path of fiscal prudence, which means private sector will have to take the load. The capacity utilization for last couple of years has remained around 75%, which is fairly positive. All the catalysts for private investments are in place in terms of banking ability to give credit, in terms of capacity utilization or debt to equity ratio for corporate sector. Yet investments have not picked up. Announcements have started happening. Whether these announcements get converted into actual spending, we'll have to see. But at least in the first half of FY26, people have started making announcements. Rupee has fallen below 90. It is going in between the big figure of 90. The real challenge for India is the net forward, which RBI or other banks have shorted in the forward market, while our reserves are shown at $700 billion rounded off. There is $65 billion short forward position. So effectively, your net FX reserve is 700 minus 65, $635 billion. With this kind of short position, can rupee come under further pressure? Quite likely, and we'll have to observe that carefully. INR has depreciated across many other currencies like GBP, yen, renminbi. This is helping increase our exports to rest of the world. But with this kind of depreciation of 5 to 16%, we should be able to do more on the export side. Our thumb rule to evaluate status of the economy is nominal GDP growth versus GST collection growth. In the first quarter, April to June, GST collection growth was faster than the nominal GDP growth. In the second quarter, thanks to the GST Bachot Utsav and rate cuts, that correlation has been broken. And today, because of this rate cuts, overall GST collection growth year to date, April to November, is well below nominal GDP growth. Will this have impact on fiscal deficit as projected by the finance minister and the budget? Or there will be abracadabra through divestment and fiscal deficit will be maintained? With all the challenges of ups and downs, on a purchasing power parity basis, India will be contributing almost 9% of incremental global growth in next 5 years. And we will be roughly about 1/5 of global economy on a purchasing power parity basis. Converting this into equity market, the index is near all-time high, but below the index, portfolios are not at all-time high. In small cap index as well as mid cap index, many stocks have fallen more than 15-20% from their 52-week high. This differentiation between men's and boys is also reflected into outperformance of mutual fund over benchmark indices, as many of us have read lemons. From a flow point of view, FPIs have been net sellers and DII have been consistent buyer. Valuation wise, our market cap to GDP ratio remains well above historical average, but profit to GDP ratio at 5.1% also is well above historical average. FPI selling is driven by the fact that in last 12 months, India has underperformed its peers. Obviously, Korea or Mexico or Brazil, which delivered more than 40% return, attracted capital flows. And India, which underperformed all other markets, witnessed outflows. This was also driven by the fact that for last 6 quarters from June 24 to September 24, Nifty 50 PAT growth was in single digit. Your PE ratio is in double digit and earnings growth is in single digit. That's obviously going to disappoint investors. The good part, while large caps delivered single digit earnings growth, mid caps or beyond large caps delivered double digit growth in last 3 quarters. FPI has been consistently selling since 2020 their ownership of equity is now around 15.6%. Now, this 15.6%, we have to evaluate vis-a-vis our benchmark index weight in MSCI Emerging Market Index. That's the index which most FPI follow. Now, this is based on market estimates and EPFR of about $800 billion investments by FPI, 120 is by index fund, and 680 is by active funds. Index funds by nature will replicate index, so their weightage is about 18.5%, copying benchmark weight, which means active funds are only having 15.1% weight, not 15.6% weight. Underweight of active FPI is more than what is visible to the eye. Will they continue to sell, or at some point of time they will decide having 3% lower weightage in India over benchmark index is too much and let me stop selling? The FPI selling was driven by underperformance of India. Last 6-quarter EPS growth in Nifty 50 single digit, US tariff, and probably IPO supply. The DIIs have consistently kept on buying, probably looking at the future in terms of potential earnings rebound and valuations coming to historical average. From trading at a much higher premium to China, now we have come almost around our historical premium to China. Same thing vis-a-vis emerging market, from trading well above historical average, now we are almost near historical average. We normally trade at 67% premium to MSCI emerging market. Sorry, we are currently trading at 67% to MSCI emerging market average. Our historical average is 63%. Will this push FPI to start looking back at India? Quite likely. Even from an economic point of view, over last many years, G7 share in global economy has kept on coming down, and led by China, BRICS share in global economy has kept on going up. This is not reflected into their investment as much as American market kept on outperforming BRICS market. Can market start reflecting economy at some point of time? Second, there has been cycle where America does better than emerging market and vice versa. Since almost 2011, American markets have kept on outperforming emerging market. Maybe this cycle can come to an end. More importantly, from India's point of view, our earnings growth should rebound in FY27 over FY26. That could also bring FPIs to our market. Earnings growth in India will be driven by sectors like telecom, cement, auto, financial services, and chemicals. Of course, there will be sectors like IT and utility which may underperform broad market earnings growth. From a valuation point of view, large cap is trading around its historical average. Historical average is 21 times. We are trading at 21.5 times. The small cap trades at a significant premium to its historical average, 16.7. versus 29.2. The IPO supply continues to remain strong. And while there are IPOs like Misho, which opens at a significant premium, there are also IPOs which are opening at a significant discount. Overall, we still believe markets will be range bound, and it will continue to watch what happens on the tariff deal. If there is a favorable tariff deal with US, there could be relief rally in the market temporarily, and then sectors like textiles, gem and jewelry, aquaculture, they could bounce back depending upon how the tariff deal is structured. We believe FPI flows, selling intensity will come down in calendar year 26, and net FY27, they will be a buyer rather than seller. Markets will obviously keep a close watch on Indo-Pak tension, geopolitical risk, IPO supply, and earnings growth, which is on rebound. Over last 5 years, almost 300 stocks have delivered more than 100% return. 192 stocks even today are trading at more than 50 PE. And our outlook remains that going forward, return expectations will have to be moderated, partly because there is no scope for valuation re-rating, and hence earnings growth will be driver for your stock market return. If you are coming with expectation of last 5 years return in small and mid cap, you are likely to get disappointed. But if you are coming with expectation of high single digit, low double digit return over a period of time, that may materialize. As distributor, we'll have to convince our investors to stay invested for longer term with moderated return expectation. We believe for calendar year 26, FY27, mid caps will outperform market first, then large caps, and small caps probably will underperform market because of the higher valuation. Portfolio wise, neutral weight to equity, equal weight to large and mid cap, and underweight to small cap. From an opportunity point of view, our fund on a rolling return basis continue to add value to investors by outperforming benchmark indices across various time period in equity as well as hybrid funds. On a point-to-point basis, as I mentioned, small cap fund has failed to deliver. Mid cap fund, while the returns are absolutely in absolute term 20 to 25%, yet compared to benchmark, it has underperformed. In hybrid and equity, again, there is outperformance across most funds, most time periods. And on the SIP basis, again, small cap and mid caps have failed to deliver, but rest of the funds have outperformed benchmark indices significantly. So despite all the noise about active funds not adding value, the data suggests completely differently. Two funds which we want to bring to your attention. One, business cycle fund. This is the fund where fund manager moves from one sector to another. Likely that our calls will go more right than individual investors. Second, there is tax deferment as we move from one sector to another. This tax deferment itself will create better alpha for investors. Instead of you jumping from one sector to another, this kind of fund will be a more appropriate. Surprisingly, this fund is right at the top of the peer group. It is managed by Harish himself. While one of his fund is right at the top, the other fund, small cap, is right at the bottom. He has the largest divergence across our fund managers. Normally, we want to remain in the middle path, but हरीश भाई ने बीच में से एक BST की बस निकाल दी है. The second fund which we have for your consideration is Pioneer. This is investing into innovative companies in local market as well as global market. About 80% is local, 17% is global. And again, this fund has not only delivered alpha, but outperformed majority of its peer. This fund also is managed by Harish. And I'm just trying to showcase that many a times when you build your portfolio, some calls come right, some doesn't. Two of the three funds managed by Harish is right at the top quartile, and one fund is right at the bottom quartile. And which is why I think this is time to invest in Kotak Small Cap Fund. That construction of portfolio has taken the pain of underperformance, and from here onwards, not necessarily tomorrow, but over next 3-6 months, you will see a rebound. We are launching Kotak Dividend Yield Fund. Again, this is to fill the gap for appropriate opportunity going forward. As all of you know, dividend is one component of the total return. There are many companies which deliver less market return but higher dividend yield, and total return combined is still reasonable. By and large, dividend yield stocks underperform in momentum and outperform in correction. So they have lesser volatility compared to normal equity. You can have a look at dividend yield offer document and material, and wherever appropriate for your customers, you could look to invest in it. Our passive portfolio continues to expand. We are one of the lowest expense passive fund house in the country. And now we will launch a couple of fund on this passive fund, both thematic and sectoral. They all become one-shop solution for the customers. These are our recommendation on passive funds. Coming to debt market, US inflation has started cooling off, but it is still above Fed's target of 2%. There is reasonable possibility of a rate cut today, and market is expecting Fed to do another 2-3 rate cuts by next year. The RBI is betting like T20. In this credit policy, they gave OMO for 1 lakh crore. They cut repo rate by 25 basis points, and they also liberalized various banking guidelines to support growth from a credit point of view. RBI could do this because inflation has come down significantly. Our inflation also includes gold price movement. If we remove gold, then we are actually in negative inflation. The projection for current year, which when we started in April 25, was about 4%. As we are nearing towards end, it has come down to 2%. The actual inflation has undershot RBI's projection by a significant margin. This is giving confidence to RBI to cut rates and keep on supporting growth, even though it is in higher trajectory. Unfortunately, despite all the support by RBI, 10-year yields and 30-year yields have kept on moving up. Today, as I speak, 10-year yield is roughly about 6.6. After almost 125 basis point rate cut, yield has gone up, not come down. There is likelihood that India could enter into Bloomberg index on global aggregate index level. If that happens, one could probably see $25 billion inflows into debt market in India. That again could have positive impact on yield. RBI is on pro-growth basis, but their communication is creating confusion in the minds of market participants. Like you announced OMO, and if you buy government securities at a price, it becomes a yield signal. If 10-year yield is 660 and RBI decides to do OMO at 6.5, it tells market that RBI is not comfortable with 660 10-year yield and it should settle at 6.5. While RBI has announced OMO, in press conference, they have mentioned that OMO is not yield signal, it is only liquidity management tool. So I am conducting auction whereby I am buying at lower than the market yield, but it is only for providing liquidity. Don't consider it as a yield signal. The entire impact of OMO disappears because of such communication, and which is why yields have gone higher. In the debt market, income and arbitrage fund of fund continues to be appropriate for high tax payers. After 2 years of investment in growth plan of income and arbitrage fund of fund, your tax rate comes down to 12.5%. In all other forms of debt investment, tax rates will be at slab rates, highest being 39%. Effectively, 12.5 versus 39 is a no-brainer. This fund, we are market leader with almost 7,000 crore of AUM. Do share it with your HNI clients. Gold, we have been bullish since March 20. In social media, you have seen my old clips being circulated saying that Nilesh Bhai didn't advocate investment in gold. Some of our peer group also circulate those kind of clips. But please remember to judge fund manager based on monthly market outlook or annual outlook or our allocation in asset allocation fund. Since 2020, we have been allocating into gold in our asset allocation fund, and we have started allocating silver somewhere in mid 2025. Our allocation to silver is one of the highest in entire industry. So my only submission to you and your client, please don't spread a short video clip from a 10-year-old prediction and rely on that. We have many people who are jealous of our success in industry, outside of industry. There are many influencers who are jealous of us and hence continue to make this propaganda. Ultimately, this will also influence your customer. They are not propagating mutual fund. They are propagating their own advisory. And you have recently seen someone getting fined 500 crore plus. I doubt if there is single mutual fund distributor who, after providing return to investor, earns 500 crore in commission. And this guy, who would have probably not earned anything for their customer, certainly he didn't earn for himself, is getting that kind of money. This is the power of social media, and which is why we need your support in sharing our outlook, our annual outlook, our presentation, and our asset allocation, fund allocation to convince client what our view is. In terms of gold and silver, there has been phenomenal run. Probably this is driven by the fact that there is limited mining opportunities in gold, little higher in silver, but compared to demand, still getting restricted. The central banks continue to buy almost 1,000 tons of gold, almost as much as what Indian and Chinese housewives are buying. There is also uncertainty because of US policies, geopolitical risk. Whenever it goes up, it benefits precious metal. And we have seen in advanced economies, a large portion of their reserves in gold. The emerging markets like India, China, Brazil, Russia is substantially lower. We believe over a period of time, emerging markets allocation to gold as a percentage of FX reserves will meet first global average and eventually advanced economy average. As long as central banks are buying gold and there is no manufactured gold, lab-grown gold, gold prices should remain supported. Doesn't mean that last year kind of return will come, but still it should outperform fixed income. Will there be rumors about gold and silver? Undoubtedly, yes. China हाथी का दांत है, दिखाता कुछ है, चबाता कुछ है. People believe the unofficial purchase of gold by China is 5 to 10 times more than their official purchases. IMF gives us C grade for not revising GDP base year, but to China, IMF cannot say anything, even though their data is wrong by 5 to 10 times. The other thing which could probably push gold, and today we met a gold financing NBFC. 10 years back, pledging gold to borrow loan was distress. जब सारे रास्ते बंद हो गए तो you go and pledge families gold. Today it's becoming part and parcel of business. दिवाली है, फटाके की दुकान चालू करनी है, pledge wife's jewelry, take a loan, start फटाके की दुकान, sell the fatakes and get the jewelry out. Uttarayan aa rahi hai, not all over India, but certainly in Gujarat, people will pledge gold to take money to set up kite and manja factory. On silver, supply has been consistently below the demand for last almost 5 years, and the gap will continue this year as well. This also is supporting silver prices. The demand for silver is mainly coming today from industrial purposes, but there are rumors that Saudi Central Bank, Russian Central Bank are buying silver through fronts. It's not officially disclosed, but people estimate that this large buying is done by central banks. The gold-silver ratio is now trending towards historical average. Our view for a while in last 6-8 months was that silver momentum is strong and you should overweight silver over gold. Now our view is becoming neutral towards gold and silver. The silver gold ratio is coming to its historical average. Now there's nothing much to choose between silver and gold. Our outlook remains positive, but probably after recent rally in silver, gold and silver returns should be nearer to each other rather than having a wide gap. Obviously, when you are investing in gold and silver, please remember there is no intrinsic value in this precious metal, no bonus, no rights, no cash flow, no dividend. It's a perception of value. Hence, we always say it should be restricted amount of your portfolio. You can't put 100% in gold and silver, in our opinion. Of course, if your risk permits, go ahead and do it, but it will be a high risk call. So gold and silver, positive outlook as long as central banks buy. Every month, please see our monthly outlook to figure out whether central banks are buying or not. If there is lab grown gold, silver, please dump all your gold and silver. The prices will come down like lab grown diamond. And please invest with limit of your portfolio in gold and silver, because it's perception of value. There's no fundamental value like a stock.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.